You know, many investors today have grown skeptical about owning stocks in their retirement portfolios. But there may be reason for some hope. Joining me today is Tresse. He's with Bernstein Global Wealth Management with offices here in San Diego. Good morning to you.
Good morning, David.
So there is hope out there.
Look, there's no doubt that investors have fled stock for the last several years, and who can blame them given the roller coaster ride? Today, there's a safety bubble. People are willing to overpay for low risk. And when you look at what they've gone to,
right,
interest rates on cash and bonds are historically low levels. And so our premise is that while Dow 20,000 sounds provocative, the assumptions are fairly conservative. And the main assertion is that 10 years from now, investors will look back and wish they had stuck to their stock allocation, if not slightly increased.
So you've done this study, Dow 20,000. Right now, we keep hovering around the 12,000, 13,000 mark.
Sure.
But you really believe that this can be accomplished?
Yeah, and we're coming off the heels of a so-called lost decade where stocks have returned nothing over a 10-year period. And there's been plenty of them over the last century. But what's interesting is there's never been a back-to-back lost decade. In fact, stocks have done very well relative to bonds in the next 10-year period.
You've got some graphics. Let's take a look at this first one and explain what
Sure.
you're talking about here with this graphic.
Well, this is just simply looking at the return that next 10 years. And on average, stocks have beaten bonds by about 5 or 6%.
Simple as that. They've beaten bonds 5-6%.
Yeah, and most of those charts came in the Great Depression era, early 70s, and most recent in the 2008 global credit crisis.
Isn't this a different environment that we're talking about today with the whole European market volatile and everybody concerned about that?
Yes. Look, there's certainly an enormous amount of risk, but our assumptions are fairly conservative again, and they definitely factor in the global challenges that companies may have to endure. And if you look at the math, 9% annual return, which is less than the long-term average, gets you to Dow 20,000, a 50% increase in 5 years. If things are more challenging and companies grow at a meager 5%, half the long-term average rate, it takes a decade, but you get there.
The double digits are gone, though. The double-digit returns that we got used to there for a while.
There'll be there'll be a couple great years here and there, but not like it was in the 80s and 90s.
Another graphic. Let's throw up a second graphic here and tell us what you're talking about here with this one.
Well, look, when you look at how do you get earnings growth to be so strong, really there's three main factors. First, you have inflation. Stuff costs more every year, including the price of stocks.
Sure.
Secondly, you have population growth. There's more people on the planet for companies to sell stuff to. And lastly, you have productivity gains. So through globalization and technological advances, companies can generate more output per employee. So when you do the math, 3% inflation, 1% population growth, 2% productivity gain, gets you that 6% earnings, add on a 2% dividend, and a return to normal valuations, and there's your 9%.
There it is. All right, let's look at a third graphic that you also brought to us and tell us what we're talking about here.
Yeah, so this is just the building blocks of the 6%. And again, the key thing is today, investors are very fearful, and they need to construct an allocation that balances two risks. One's the risk of short-term loss of the portfolio due to stock market volatility, which is annoying.
Yeah.
But the second risk is more long-term in nature, and that's where investors are too conservative and their portfolios can't keep up with their spending, and so they run out of money. So more than annoying, it's a catastrophe. And so they need to balance those two risks and construct a thoughtful allocation, and here's the hard part. They need to stick to it. In times of euphoria, where they want to go all in on stocks, they need to be disciplined. And in times like today, where things are moments of despair, they need to have some courage and hang in there.
Yeah, and I'm like a lot of investors. I'm sure that I have my 401, but it seems like the closer I get to retirement, the further retirement gets from me. Why not play it safe? Why not just do it with cash and bonds? Is that not the way to go?
That leads to that second long-term risk of the portfolio just not having enough growth potential. And look at the 10-year Treasury today. It's 1.5% before tax.
Yeah.
That's hardly going to be enough to maintain a comfortable lifestyle in retirement.
It's a bit of a gamble, but you're saying it's going to be worthwhile in the long run.
Perhaps a gamble in the very short run, but over the long term, not so much.
All right, Tresse, thank you so much. We
My
appreciate
pleasure.
your time.